Hey guys, it's the Simple Investor here. Today we're going to be taking a look at Disney stock who just reported earnings that were actually quite impressive, but disappointed the market. But before we get to it, be sure to like this video and to subscribe to the channel if you enjoy this content, as it really helps the channel out. But let's get right to it. So Disney reported earnings today that actually exceeded the expectations of analysts, but it disappointed the market here. As you can see, the stock kind of petered out to close today, down close to 5%. But to their earnings here, what they delivered was a revenue increase of 23.2 billion from 22.3 billion in the prior year quarter. And their income was actually quite impressive, considering that they went from a $3.1 billion income from a 0.1 billion loss in the prior year quarter. And then their earnings per share as well was up to 143 for the current quarter, compared to a loss of 0.25 in the prior year quarter. Again, Disney recently purchased 21st Century Fox for quite a significant amount of money. I believe it was in the $20 to $30 billion range. And that has been eating into a lot of their cash flow. And they've been servicing that debt, those debt charges, and paying off that acquisition. So that's been eating into a lot of their free cash flow as well. And then there's been some political backlash too, along with Disney Plus hasn't been as popular as a lot of people had anticipated it would be. And Disney hasn't done the greatest job of maximizing its potential with inconsistent pricing and such, but we'll get into that later. But to their numbers here, we're looking at here revenue. So the revenue, again, we were looking at was a nice increase year over year. Their free cash flow here, I was a little disappointed that their free cash flow has quarter three last year, and then quarter three this year, their free cash flow was down a little bit here. And then if we actually look at the 9-month range, their free cash flow was up. So it's depending on how you look at it, but quarter over quarter, not great for free cash flow, and that's something you want to see for a company like Disney. You'd like to see that continue to grow. Why the market did not like them was just the fact that this right here, so their experiences, so that's like going to parks, cruises, things like that, was down. The market was really hoping that that was going to be up. Their streaming was up. We'll get into that too later, which was nice to see. But yeah, you can see right here, so direct to consumer, so that would be Disney Plus. You can see that was up here 15%. So that's not too bad for them. That's kind of nice to see. So they're kind of getting out of the slump they've been in. I mean, the stock has been stagnant the last 5 years. So that's good. They've got some really nice growth in some areas where they've been weak in. But taking a look here at where kind of they project themselves going here, what I was really looking at was just to kind of see how they've been maximizing their intellectual property. So we look here, Inside Out 2 has become their highest grossing animated film ever, with 1.5 billion at the box office. So that's great to see. They've also got Deadpool and Wolverine playing at the theaters, and that's doing exceptionally well as well. And then they've got some nice intellectual properties coming down the pipeline as well. They've got Moana 2 coming out this year. And then they've got a live action one coming out in 2026, and that's been a popular movie when it came out in 2016. And then they've even got some more very, very popular intellectual properties here as well. So you've got Toy Story 5 coming out in 2026. And then they also have Avengers here. I know some of the Marvel pieces that have come out recently haven't been as popular as maybe Disney had hoped for, and hasn't really resonated ever since Endgame came out. So it'll be interesting to see kind of how they take this Avengers movie franchise going forward, and if it can kind of return to its glory days, which was before the Endgame. And then Star Wars here, they've got more Star Wars content coming out. They've also got The Mandalorian coming out as well. Again, some more popular series that'll go on Disney Plus. And then we've got Avatar here. So there's 3 Avatar sequels coming in 2025, 2029, and 2031. Also an experience opening up at Disneyland Resort. So that'll be interesting to see how that actualizes. That's one of the more popular franchises as well. And then I just want to add here as well, they also have 3 Star Wars films coming on top of The Mandalorian and Grogu. So that's impressive, because those are intellectual properties that are all very popular. So that's promising for Disney coming down the road. And then kind of going down, I was really interested to see kind of how their streaming was going here. Yeah, so you can see they did have some streaming growth here. You can see that it's marginal growth here, but they are seeing some Disney Plus growth, because this is an area that's been a little bit weak for them. One area where I wanted to see them really grow was in their streaming, and it's a little bit lackluster because just yesterday they're talking about raising the price. Well, they are going to raise the price for Hulu, Disney Plus, and ESPN Plus, and really that's not going to attract people who aren't Disney Plus subscribers to the platform, and that's not really going to grow their bottom line. I mean, out of all the streaming services, you could argue Disney Plus has the widest array of content available that is really marketable to pretty much anyone. Like, I think there's something in Disney's catalog that everyone can agree to want to watch and would enjoy watching. So I'm kind of disappointed to see that they keep raising the prices. The prices keep raising consistently, and it's not something that makes me very bullish on the stock. Just because if you think about the idea behind streaming, is there's not a lot of overhead when it comes to streaming. I mean, they have to produce the content or whatever, but they can really make a lot of money on subscriptions because subscriptions are a recurring basis. And if you keep the prices consistent and you're only marginally increasing the prices every few years, you're going to keep a more consistent user base and a subscription base going. When they keep raising the prices here, it's not looking great for the stock. I mean, the only one thing that I don't mind that they're doing is they're starting to raise the prices with bundling. So they're bundling Hulu, Disney Plus, and ESPN Plus, which is better than just raising the price on Disney Plus because there's more value there. You can make a value argument. But again, they have been the one streaming service that's been raising the prices the most the past few years. And just in February here, there's an article that talks about how they're continuously bleeding subscribers as well, and they're not taking a profit loss. They're actually taking a loss on Disney Plus. But now these earnings were interesting because it was kind of buried in here a little bit. But they produced their first ever profit on Disney Plus, so that was promising to see. But again, I'm just not bullish on the fact that if they're going to keep raising prices on Disney Plus in a time when the consumer is arguably very pinched right now, just in the monetary tightening cycle we're in a high inflationary environment as well. I just don't see how, if they're going to continuously raise prices, how that's sustainable for them going forward. But time will tell. But I want to break it down here to kind of where their sales and revenue and what their balance sheet looks like right now and visualize it. So you can see here, their parks and experiences and consumer products here is the second kind of revenue generator for them, and then entertainment and streaming is kind of their bread and butter. Like if you look here, you've got your linear networks, so that's ABC, and you've got your streaming here. So again, this actually had a nice increase. So that's why it's so important. They have to be really careful how many of these price increases they're doing, because this is the one area where I really see they can have the most margin expansion. There's a lot more profit margin that can be had on something like direct to consumer rather than parks and experience. You can only squeeze those margins so much when you look at the parks, where direct to consumer and content like this, you can really make those margins go a lot further. And then just looking at their revenue here, obviously with just the way their business works, there's a lot of expenses involved, but they produce some nice profits here. So again, it's not too bad. I think it was a pretty solid earnings for them. What I really think the market was disappointed in was the parks and experience growth. It was actually, there was no growth. It was in a negative actualization compared to what it was quarter last year. So it'll be just interesting to see going forward too, as we look into this looser monetary period coming up, when you're going to see more interest rate cuts globally, and then especially with the Fed likely to cut interest rates in September. It'll be interesting to see in the subsequent quarters to see them what they do in terms of how they report their earnings. With parks and experiences, I do think that you will see growth there because access to debt will be cheaper, and you'll see people spend on things like going to Disneyland and going on vacations and spending on those kind of things. But it'll be really interesting to see kind of where that goes. But from a valuation perspective today, taking a look at the stock, I mean, the stock here trades at a 92 price over earnings ratio. So that is quite high. I mean, it is quite high relative to what it's been in the past. I mean, here you're looking at, it's quite high compared to what it was like just even a year ago. I mean, it was producing just awful numbers a year ago. I mean, they were reporting losses this time a year ago, but they're in the positive now. But again, you're still paying quite a hefty price for the stock. And then two, taking a look at their debt to equity ratio, they're actually in not a bad position here as well, with long-term debt sitting at 39.51 billion to equity of 103.76 billion. So again, they're in a healthy position in terms of their debt to equity ratio. That's not something I'm too concerned with. It seems as though as the Fox and their acquisition of Fox, they're paying that off and they're able to get themselves into a good fiscal position. The one part that, again, when we were looking at their earnings, the one part that did concern me is their free cash flow growth didn't seem to equate quarter over quarter last year's quarter. But if you actualized it over a 9-month period, we did see that they had some nice free cash flow growth. But again, I'd like to see that reflect year over quarter, because in that way you can actually get a really good picture of kind of where they're going in terms of their free cash flow. But for me, I hold Disney stock. It's one of the positions I'm actually at quite a bit of a loss on. I bought it back in 2021. It is not a position I'm looking to buy at the moment. I think there are better stocks out on the market, better valuations out on the market. That'll be another video. But I don't. And I'm not too bullish on the business as well. I just think that they're squeezing margins, and I'm not a fan of how they're handling streaming. I think bundling subscriptions with ESPN, Hulu, and Disney Plus is the right approach for them. I just don't like them continuously raising prices, and I consistently see how Netflix and Apple TV Plus and Amazon Prime are just offering better value for the consumer at a time when the consumer is arguably very pinched. I just don't see how there's a lot of value there, and I don't like seeing the prices being raised. So for me, Disney is a hold. It's not one I'd look to sell. I would consider offloading it if I was in a position where I was to make a gain on it. But at this time, it's a hold for me. But I'd love to know what you guys think. Is Disney a hold for you? Is it a buy? Is it a sell? Let me know in that comment section below. Be sure to like and subscribe if you enjoyed this content, and we'll see you guys next time.